Hello, everyone. This is Scott Mitchell, SDR's Managing Director with SDR's Deal Readiness Educational Series. Today, we're going to talk about evaluating an unsolicited offer. It's often the case that a buyer will come to you and you didn't even ask for an offer, but they're going to put something in front of you. What we want to give you is SDR's 3 C's framework for evaluating an offer. The first C is the consideration. How do I know if the headline price is fair and the transaction structure is reasonable? Can you access investment banking research about how your industry trades? Oftentimes, businesses trade as either a multiple of revenue or EBITDA. You should be able to find some reporting that gives you a good sense of whether the offer is in the ballpark. Probably even more important than that headline number is the structure of the deal. The typical components of a deal are cash, equity roll, seller note, and perhaps a performance-based earnout. Less than 10% of deals are straight cash, so it's really important to understand that structure. We find that oftentimes a $50 million deal with significant structure may not be as attractive as a $42 million deal that's mostly cash. The second C is certainty of close. Studies suggest only 20 to 30% of all deals close. Certainty of close is not just about closing any deal, but about closing the deal that was agreed upon at the letter of intent. Well, why might a deal not close at what was in the letter of intent? Well, let's be honest. Buyers oftentimes, they want to put on that engagement ring before they've actually decided if they want to marry you or not. Why might they walk away from a deal? Well, it could be lack of funding. It could be lack of relevant experience in your industry and understanding how your business works. It could be due diligence issues that they find, perhaps poor accounting. You don't have all your permits. It could be an environmental issue. And lastly, honestly, a lot of buyers will get deep into due diligence and then use retrade as a strategy. They will sign you up at one value and then retrade you down late when they think they have the leverage. The last C is closure. So from a deal standpoint, you've got surviving deal terms. These are things like the indemnity escrow, deferred compensation, your employment agreement, stock reinvestment. All of these terms are super important and may last for years after the deal closes. Just as important is the legacy about what you want to do with your life and your team's situation after close. Is this the right fit as a buyer? Is this a good home for your employees and for your executive team? What's your personal ongoing role in the business going forward? Are you going to be staying around for a long period of time? And are you in the same position or a new one? Lastly, for a lot of sellers, they have not contemplated really the liquidity event consequences that come with a deal. It could be tax considerations, estate planning, trust planning, financial management. Is this the money that you need to accomplish your goals in life after the deal closes? So this is SDR's 3 C's framework. Remember that recapitalizing your business is one of the most important decisions you'll ever make. Just because you have a viable buyer doesn't mean it's the right one. SDR exists to help founders and entrepreneurs through these life-changing and irreversible decisions. In fact, we have a track record of increasing the final purchase price over an unsolicited offer by 68%. So give us a call if you find yourself in this situation.